This podcast is proudly brought to you by Term Plus. What I like about Term Plus is its easy to use online platform, giving you access to high-yield term-based accounts, providing consistent monthly income. Owned and operated by Pengana, an ASIC-listed company with 23 years of experience, Term Plus is democratizing access to global private credit markets. Visit termplus.com.au to learn more and read the PDS before investing. I'm proud to say that this Rask podcast episode is brought to you by PIMCO, one of the world's leading fixed income investment managers. With more than 50 years of experience in navigating complex global markets, trillions of dollars under management, and a global team of experts, PIMCO is a name trusted by investors worldwide. Discover how PIMCO can help you build a more resilient portfolio at pimco.com/au.
Welcome to another episode of the Australian Retirement Podcast, coming to you fresh every Thursday. Finding as many questions, trying to reach the zeitgeist of what's happening in retirement around Australia and possibly around the world. I know we've got some listeners from overseas too. Here with my fabulous co-host and friend James.
Hey, mate.
Welcome back.
Great use of the word zeitgeist.
Yeah, zeitgeist. I'm just trying to... Well, you've always got these really good... I don't know if they're anecdotes or they're just factoids. Maybe I'll use factoid. That I'm trying to work on those and just be incredibly aware of the... references that I make, because I think I'm better at writing than I am at speaking sometimes, or typing, definitely not writing. But today we've got this one's probably close to both of our hearts and massive kind of in the headlines. It has been for a few weeks, for a few months now, and it's not showing any signs of going in the way in the next few weeks after that. We're going to talk about the First Guardian and Shield Master Fund issues, which will link us into Commonwealth's, the scheme of last resort, AFCA. We'll go into all these kind of areas. We're only going to touch on it, so if you're involved, you might want to listen. If you're not, there's probably some takeaways about how to avoid the kind of scams and bad investment decisions that come up. But before that, we're coming off the back of school holidays, and you had a. I mean, it can be whether you're a grandparent, a retiree, or not, or just a parent. It can be an incredibly challenging period. You had a good time though.
Yeah, brilliant. Thank you.
You look refreshed.
Yeah, I feel good. I feel good. We went to Bright for a little while. Absolutely love it. Northeastern Victoria, and just had a wonderful weekend there. And then we went to Tagati the following weekend and did some camping. I was having a laugh with my wife about the putting kids down 5 and 7, and then especially in this little rickety cabin in Tagati where every footstep is like 150 decibels through the cabin, and how quietly, like, you've invested so much to get them settled and down, and we just want to go and hang with our mates by the fire. Now, like, parenting time is over.
Yeah,
that's right. And every part of the house, like the floor, the doors, the front door, the security gate, are just so loud.
Yeah.
It's like, someone...
And it feels louder as well. Yeah.
Why are we not building these bloody cabins to take into account that parents are going to want to put their kids to sleep and then go outside and sit by a fire with their friends? So we had a couple of false starts, but anyway... That was us. How'd you go?
I had a similar one, which it kind of brought up. I mean, anything that happens, you kind of go, oh, this would be a good retirement plan. We rented. So have you heard of Ripper Ride? Similar. This could be relevant for retirees looking to travel. So it's like Airbnb, but founded by an Australian.
I'm on it.
Yeah, and it is like Airbnb with the story. So it's like storytelling. It's much more rustic, and it seems to be in like a lot more, not necessarily remote areas, but kind of more unique. Like if you think about the most popular Airbnbs, it's like the more unique Airbnbs. So we rented a log cabin out in Warburton, so near the Yarra Valley. I thought it was in the Yarra Valley. It's
beautiful
away from the Yarra Valley. Yeah, beautiful. Like driving up the end of a mountain, all that sort of stuff. But what was interesting, not the log cabin, not the wood fire, all those kind of things, and getting kids to cook their own pizza. But it was actually this beautiful thing started like it was just a farm, and the people were spending so much time at work. Their work was about half an hour away, and it slowly evolved into. They basically built a space to have parties. So it had like this big outdoor area, wood fire oven, a bar, outdoor fireplace, bunk rooms, all wood, like kind of cool. And it's basically turned into, and they tell a story when you go there. So you read through this whole story. Maybe it's, write a book about your retirement story. And it basically just became this not even a retirement plan, but a retirement add-on where their party area, they can still use the party area whenever they want. and they're renting this on Ripperide to have families enjoy the area that is Warburton.
How
or
good.
have this additional income stream. I thought it was, and it's any time you're surrounded in wood and sleep, it's like you automatically relax a little bit more.
I agree, and I'm fascinated by that statement. Normally when people make those statements, my attention pricks. I'm like, okay, prove it. Anecdotally, I'm with you.
And that polished wood and everything's noisy. Like you use like you were saying, you use the shower and it sounds like hollow. It's just but there's probably too much information for this episode. We want to keep this kind of sharp and a bit tight, but there's something massive been happening in the industry, and almost every part of the financial advice and investment industry is involved in this. And one of the issues is it's quite complex. It's very similar, but there's actually two different examples of it that we're going to go through. And I might hand to you to kind of explain the Shield and First Guardian issues that have arisen. Let's call them issues or examples. And for context, First Guardian and Shield are different groups. First Guardian and Falcon Asset Management, I believe it's called, where the kind of combined entity on one side, and Shield and Keystone on the other side. Mm-hmm. But I might start with you and maybe let's just banter and back and forth around who's been impacted by this, who are the parties involved, what is ASIC doing, and what do people need to know about what's happening here.
Yeah, this is huge, and it's absolutely devastating for a huge number of Australians. The essentially both Shield and First Guardian were investments, and there are investments available through a number of different superannuation funds. Now, with more time and more research and more being uncovered, it's transpired that the underlying assets in these particular investments were extremely conflicted and in a lot of cases fraudulent.
There's one thing to go into illiquid assets and high risk assets. There's another thing to be spending it allegedly on apartments, penthouses.
And so the issue here, and please take this with a good nature, it's intended to everyone that's listening. There are always, no, I said that's listening.
I'm listening.
I know you won't. There are always going to be fraudulent investments. Like the idea of fraudulent investments is as old as investments itself. Is a sad situation, but that's going to be one of the realities of investing always. The problem here is the way that this proliferated and the way that in the 21st century, so quickly, 2025, we're at a point where we had these investments on major platforms with mum and dad investors looking at this and saying, yeah, this does look like a good investment. It's been approved by a financial advisor. It's on a very reputable platform. Everything stacks up. Let's put money into these. And they are the mums and dads who have done what I would describe as a reasonable level of due diligence and still lost money.
Yeah, maybe it's worth going through those different steps of it, which is you've got the retail investor that was involved, you've got the advisor and the licensee, each advisor has to be licensed by someone who's supposed to have oversight over them. You've got the platforms who offer the ability to invest in them. You've got the research houses that support the addition of investments onto platforms. And then you've got the custodian or the group that is administering because all these things are managed investment schemes, they're unit trusts, and there's a group that's either auditing or supposed to be the custodian over that asset as well.
We're going to start off with how these companies how money was getting in there.
Yeah.
In a lot of cases, this was due to very aggressive lead generation strategies. I've personally spoken to someone, I said on the show not too long ago.
You tested it out?
I've spoken to someone who experienced this and went through it. And they were saying that they were bored on social media and they saw this opportunity to boost your super. They don't know a huge amount about their super to the point of understanding if I'm in a high performer or not, but just the copy looked attractive and I felt like I had the time. So I clicked on it. Very quickly, I'm getting a phone call from someone in Australia talking about the reasons why this investment could be really good for you, what you'd need to do. After a song and dance, they were given some financial advice. They were given a statement of advice by a licensed financial advisor who in reality was primarily recommending the same product again and again and again, but the consumer could never have known. Now there were also they started to identify some things that looked unusual as the process went on, but by that point, unfortunately, it was too late. They put their money into this investment. So that's how a lot of Australians got in. I think at last count there was around $1.2 billion of money between First Guardian and Shield, and across 12,000 investors.
Yeah, about 5,800 in Shield and 6,000 in First Guardian. And they're kind of being grouped together, but they're separate issues. The issues are very similar, but being grouped together.
So then let's keep moving along this line. So we've got the investor, in a lot of cases, tragically, mum and dad investors. I mean, it's tragic anyway, but particularly for mum and dad investors where, frankly, the money means more.
Brought in by a lead generator.
That's right. Yeah. So then we have the financial advisor. So do you want to speak to the financial advisor and the licensee and their role here?
Yeah, I thought it was quite interesting because, as you were saying, it was generated by social media. We have to be clear, we do a lot of work on social media and media, but you would be able to tell from our conversations, we aren't seeking quick action. Like, we're not product driven, we're not performance driven, and hopefully we're adding some education out there as well. But these things were all kind of marketing performance driven, and essentially what was happening was a lead generator was getting an interest from someone, selling them halfway on the product, and then passing that to a financial advisor who was facilitating their investment into a product, because you can't access platforms without a financial advisor involved. So it was actually, if you go onto ASIC, there's a whole page on it, and it shows a certain number of financial advice firms that were involved. I think it's only up to a total of 10 financial advice firms. It's less for Shield and more for First Guardian that were actively recommending these products to their clients. And I mean, where the focus, and ASIC's been clear on this, they're looking at every part of the infrastructure or the ecosystem of people involved in this the entire time. So financial advisors, these small groups of financial advisors were central to clients investing. Without them, it couldn't have gone through. And interestingly, all these assets were available to those advisors on the approved product list, driven by their dealer groups. So in financial advice groups, a company, as an advisor, you can be self-licensed. You can have your own company and license yourself that way. Or there's large dealer groups that could license 1,000 advisors, 500 advisors. And if you're in it as part of a dealer group, or even if you're operating yourself, you have a list of products that you're allowed to invest into. And seemingly, these products were all available on those approved product lists, whether they were self-licensed or a part of a dealer group, and had been, these advisors were growing exceptionally quickly by putting more money, more assets under management, and had basically, in most cases, as I understand, giving faulty SOAs. One was around lack of disclosures about everything. There's so many articles, everything from, I think one of the main giveaways was that advisors were using modeling returns of up to 15% for a balanced portfolio of investments. And for context, 7 to 8% is the average return for a balanced portfolio. But in order to help incentivize people to show them they're going to have a better outcome by making the change, they were using aggressive return assumptions. They were also I've actually heard a few rare cases as well where they would change the product they were investing to actually changed without their knowledge. And in like as much as a statement of advice can feel like it is, you should be able to trust. And yes, 100% you should be able to trust everything that's in the statement of advice. I think it incredibly important to be also questioning and reviewing these documents in detail before signing off on everything. But this is where the fraudulent part of this comes through, I think, is one, a lack of disclosures about the underlying investments, any benefits, any related parties that were involved, and then a number of changes where investments were being executed, changes were being made without even involving the client. I think the other final one, before I stop rambling, was around negative consent, which came up more recently, which was if you're working with a financial advisor, they have to have your consent, written consent, before they execute anything. There's obviously some cases like separately managed accounts, but you're aware you're going into those. But relying on negative consent. So if you don't respond to me in 14 days, I'm going to execute this for you. Advisors cannot do that without your previous written authority. Mm-hmm. So that's one of the big things that's come out of this. And if anyone takes anything, it's negative consent is not something your advisor is allowed to do.
Correct. Yeah.
I got there in the end.
So if we go to, we've talked about the client, we then go to the financial advisor. Now, I think we would both agree that the financial advisors here are deeply responsible for how this has happened. Now, this product was pitched as a defensive product. The underlying assets were, as you said, there were in a lot of cases there were properties, apartments, so on. There's nothing like what it says on the wrapper. Yeah. And then there was much worse behavior happening underneath, or worse still, looking under. Yeah. But if I can momentarily, we recently had an ad out for an associate advisor, and we had an applicant that looked like a great applicant, and her history was that she'd worked at a business called VentureEgg. Yeah. VentureEgg is linked to these. VentureEgg recommended is now a closed business and recommended a lot of First Guardian products, I looked at her resume and I spoke with her on the phone. My answer was no, I'm not going to take you to interview. But candidly, the reason why I'm not is because I can see that you've worked here. That's a huge red flag for me. Yeah. Not so much in the sense that this is necessarily a reflection of you as an individual, but like you at a minimum, with all of your applications, you should be including a cover letter to explain, here is my history and here's what happened there and here was my time there. Yeah. Because without that, you're going to be passed over by everyone. Yeah, that's right. And she said that's what's happening. No one is willing to take me on as an advisor now. And she felt like she was hit really hard done by. Like she was fairly new to the industry and she stepped into this environment where...
You could think it's normal.
You could, yeah. And that's nevertheless, in my opinion, I think we're on the same page. That is incumbent upon the advisor based on the research that you've done, based on your experiences, based on all of the study that you've done to identify that yourself and say, hey, that is not normal and that's a concern.
Yeah, exactly.
So from both a licensee perspective and a financial advisory perspective, there is fault there, significant fault.
Yeah.
Now, the investments themselves...
Yeah.
In order for people to have invested in them, they needed to be available to invest, and ideally, the more commonly available they are, then the more investment dollars are going to go in.
Yeah.
And so we end up with this huge question mark saying, how the hell did Macquarie, Netwealth, Equity Trustees, if I recall correctly, how did these organizations end up with these products on their approved product list?
Yeah.
Now, if we think, as I've explained before, if we think about these sorts of products, it's reasonable to take the lens of saying that a wrap facility like a Macquarie or a Netwealth, for example, these are like a supermarket.
Yeah.
Their offering is that we've got a tremendous amount of options available on the shelves, and you can come in and you can get whatever you want, and so that's why you should come here. However, I absolutely believe that there is a tremendous amount of fault at the platform level.
Yeah.
Like a supermarket has 10,000 items on the shelves. A platform has 800 items on the shelves. It is a very different number, and the level of due diligence that needs to be put in here was obviously lacking at that level. And I say that because ASIC they've already gone for equity trustees. Number one, they're taking action on Macquarie, although Macquarie has led the way, as far as I'm concerned, in terms of how they've remediated the issue.
Yeah, that was a positive news that came out last week. Several weeks ago.
But we agree. So we agree that there's huge fault at the advisory side here, but there's huge fault at the platform level, right?
Product, yeah.
Yeah. Okay.
There's obviously greed at the advisory level.
How do we end up with platforms having these sour investments on like the whole point is you're just shrugging. No idea.
I mean, it's like incumbency and I think almost like laziness that extends into the industry. So platforms, and we're proponents of platforms, are one of the gatekeepers to financial advice and to the investment industry. So they assist in helping administer all the tax parts and all the time-consuming, expensive parts of investing and having control of your investments. Platforms are used for those, but they also act. So there's different. Each platform, most platforms have two different sides. One of them is what's called the investment side, or IDPS, for a lack of, just to throw another acronym in there.
Thanks for that.
Yeah, and that can be a direct investment in your own name, in a family trust, in a company, which has different protections to if you own assets through superannuation. The other platforms within the platform, they also offer a superannuation option, and this is where all the focus has been lately. That they act as a super trustee, or the trustee of your superannuation assets, which means they should have a higher level of due diligence or input into what investments you can access. So in a lot of cases, the investment options in the investment IDPS are broader than what are available in super, because they don't see them as being as attractive. Interestingly, most of the investors involved in this were superannuation product, not in the investment product, which means it was approved for both.
Yes.
And that's probably, that's why Macquarie were clearly so focused on, one, dealing with the issue, and two, compensating investors. So they agreed to pay $321 million, basically make all investors through their Macquarie super product whole for all their losses.
Yes.
I thought that was the biggest part.
This is an interesting take too, the fact that they've settled that matter.
They've just done it. Yeah.
Now, as you've pointed out, with the trustee, the trustee of a superannuation account, if you think about, we've talked about self-managed super funds before and the idea of a trustee, the trustee is ultimately responsible for the management of the fund. And so even a huge superannuation fund like Macquarie, for example, that trustee, that's just responsible for a much bigger fund. And of course, that becomes a lot harder to navigate.
Yeah.
I've personally had the experience of seeing a fund on platform under, as we said, the IDPS, the investment only side, and saying, I would love for this fund to be on the superannuation side because I think it would really suit a lot of our members. And you have the platform say, yes, well, we can't do that yet because it hasn't met additional requirements. It would be very rare for a fund to be on the super side and not also the investment side.
Yeah.
And so the
track record, research reports,
also sufficient money in the investment already to justify moving it across. There's a whole heap of different things to tick, and rightly so. But if we go across to Macquarie have looked at this and said, you know what? We should not have had this Shield Master Trust on platform. We shouldn't have had it there, and that would under the super platform. That's on us. There are
or it should have been shut earlier.
Yeah, correct. Yeah, we had concerns about this earlier, which we didn't act upon. Now, I'd probably mark that down to perhaps being under-resourced in that area, but I'm not entirely sure. I think it's the nicest reason that they could not have acted upon that, frankly. Yeah. And then the kindest, to say it differently, they've looked at that and said, even though ASIC are already coming for us because they're saying, well, you can't have applied the right level of due diligence to have had these concerns raised. Macquarie has said, look, it shouldn't have been there. We're just going to own this, and we're going to work. We're going to say, what are the losses for everyone? And that tallied $321 million, and they've settled that. And
that's quite unique.
That is.
I don't think I've seen that before.
I haven't seen that before either. Yeah. Which, by the way, is great. I mean, I think in terms of consumer protection and just that one extra step, setting the standard that when you have a platform level error like that, that's how it should be remediated. Hats off to them for that particular part. Thanks for watching this episode of the podcast. A common question that we get at Rask is, how do I need to be prepared if I want to see a financial advisor? There's a few things that stand out that may really help you if you want to get the best from an advisory relationship. The first is to come prepared. It's really valuable if you can arrive at that meeting with a good sense as to what you want to achieve from an advisory relationship. Now, there's lots of different financial advisors out there that operate very differently. And if you don't have a good sense as to what you want to achieve, it can be kind of easy to get pulled into their advice philosophy and their approach. It can be hard to define what is the best advice relationship for me. So whether it's you and your partner having a good conversation to say, what do we actually want to get out of this? That will really, really help you to know that you're in the right place when you sit down with your advisor. The second one is to be open-minded. You may very well work out that there is one or two specific things that we're looking to address with our financial life. But a really good financial advisor is going to be thorough. They're not just going to look at those things. They're going to be as exhaustive as they can be about your entire financial life and make sure that everything is lined up and set up the way that it should be. So when you go into that process, please be open-minded that the highest value that you might get is not necessarily solving those one or two acute things that you wanted. The last thing is to be curious. If you are watching this podcast, it's probably because you are watching or listening. It's probably because you want to learn more about your finances. You want to level up when it comes to your education. And if you're going to meet with a financial advisor, it may be your first opportunity to transition that general knowledge that you've developed about your finances into your own situation and how it applies to you. So be curious. It makes sense for you to try to understand as well as possible, how do all these things work for me? Because at the end of the day, it's your financial journey and it's your money, and all of the advice should be helping to serve your unique situation. Now, if you want to learn more about how to get the most from your advisory relationship, you can either scan here and that will take you to a guide that gives you a heap more information. Alternatively, if you scroll down below, there is a link to a Northeast Wealth page that we put together not too long ago, and that similarly outlines the key things that you should be doing in order to get the very most from the relationship. Thanks again for watching this episode of the podcast. I'm James O'Reilly from Northeast Wealth. We hope you enjoy it.
And it is hard. I mean, I think naturally people would probably question platforms after this. I think that shows one of the reasons why they are valuable. Like it is real. The company is huge and has realized it's made a bad decision at some point, and it's compensating investors for that reason. And in most cases, they do provide a significant level of protection from these. I know there was an article not long ago that I think half the investments from Macquarie on Macquarie Wrap have now been removed. Things that weren't getting flows have now been removed from their platform. So they're taking this role seriously, and obviously follows legislation and ASIC and APRA, but only takes one group or two groups and $1 billion in low investor funds for a kind of a refresh and a reset on what people expect of due diligence.
Now we have to move. Lastly, we've done investor, we've done financial advisor, we've done platform, and we've agreed at financial advisor and platform there is absolutely fault there. And let's go to the last step, because in order for the platforms to have put these products on their platform, one of the key things that they're going to need, as you pointed out, is research. Yeah. They're going to ask for independent research on that fund, and typically that independent research would come through only a handful of product providers. Less than 10 in Australia can do that with and a big platform like a Macquarie or Netwealth say, we regard that enough to accept that research. And so we're talking, a lot of you would have heard of, for example, Lonsec, Zenith, Morningstar, SQM. Now, my understanding is that it was SQM that completed the research for both the Shield and the First Guardian Fund. Yeah. And so we now move across to the next layer of responsibility, which sits on the research house. How is it possible that the research was completed on this particular product and sufficient to say, we're rubber stamping this and we're very happy with it, and then they can present that letter to Macquarie, for example, and get it on platform? And
it's almost like a passing of blame, isn't it? Like in the GFC, companies went bankrupt, and that was kind of stock research or, hybrid, and everyone was worried about the research industry. Research plays an important role. You can't, an advisor, we can't have all the resources to both manage superannuation, build portfolios, and then analyze every single investment down to level of detail that a platform could.
Sure.
So we rely on outsourcing to researchers. It is, and my business partner wrote a pretty strong article about this in the publication recently as well, which is the research industry. It's obviously you have to pay to get a research report. So it's under this almost pay to play structure. Not saying that you pay and you get a good result, but you actually have to pay each year to have your research report done. There's very few who maybe the retail investor, the advisor, or someone else, maybe there's a better remuneration model there. But it is, I find that, a platform relying solely on research reports is kind of passing the buck on who would be responsible, in my view, and it might be a little bit out there. It doesn't matter which direction we go. I think someone's going to have opinions on this. So, but we'll always look at research reports. We obviously own an asset. We actually own an asset consulting firm. We don't do, Atchison doesn't do research reports. We do internal research to make sure our product, anything we recommend is good, but we don't do those sort of research reports. But it is the next step, and it kind of opens up this world of who are the gatekeepers to making investments available.
Yeah, because I agree. You've got a system where everyone is independently relying on others,
but no one's got ultimate responsibility.
That's right. Yeah.
You pass that down to the retail investor, basically.
Yeah, correct. So let's now talk. So we've spoken about that responsibility chain, and in the financial services sector, one of the really the complex elements of this is that there is genuine responsibility at the advisory level, at the platform level, and at the research level.
Yeah, and the licensee level.
Yeah. And that's unique.
And not saying whose level of responsibility. We're not making judgments.
ASIC will do that for us, I think, at some point. So let's now talk about how this is going to affect people.
Yeah.
We've got $1.2 billion of lost money, where in the case of the individual that I was talking to, she described having logged into a super balance, which was previously $120,000, and then logged in the next day and it was $34,000.
Yeah.
Just bam. what happens to these people that have lost this money?
I thought it was interesting. So in Macquarie's case, Macquarie was the Shield Master Fund, that Macquarie's agreed to pay dollar for dollar what people invested into it, but they expect to get 60% of that money back or thereabouts of the money back from Shield through the sale, the administration process, the administration that's going through at the moment. So in some cases, you will be able to, there is some value in what's going on. It's not a completely fraudulent Ponzi scheme where there aren't assets. In some case, there is a portion of assets that could be returned over time. But this naturally goes down the route which we've talked about before, is how are you made good for what is clearly, according to ASIC, industrial scale misconduct, across the investment industry. And this is where multiple options come in. So it starts at one, the advisory firm that we were working with, and the key here is making a formal complaint against the advisory firm if you're one of those people involved. And a lot of advisors, I'm sure you've helped put in complaint, like help prepare complaints or deal with clients who've been involved in other collapses in the past and help them go through that process, because it can be complicated. It feels a bit legalistic at times as well. But the first course of action is to contact that financial advice firm, lodge formal process of complaints, and then from there you can begin to escalate it. And this is what ASIC says as well, that you need to go make a complaint via AFCA to the advice firm that delivered the advice. The problem, and this comes up all the time, is that most of these firms are now insolvent, which means they're no longer able to pay, or they have no assets, they're bankrupt, they're no longer able to pay the amounts that you're due. And then while every advisor has to have professional indemnity insurance, indemnity insurance is only going to cover a certain amount in this case, if it even covers the past history. Which is where it gets incredibly complicated. Yeah. And we've talked about the extension of this before, which is once you get to the complaint process, they'll only pay up to a certain amount at AFCA, which is $150,000. And what happens, we've actually got a direct question on this today as well in the show notes. Once you get past that 150,000, you have to, there's an extension of this that then can help make, if you've invested 1.2 million, you've lost $800,000, you're still $650,000 short. So where do you go next? And this is the thing that's been massive for financial advice. I think you're a big voice on this as well, which is the compensation scheme of last resort. So where those groups go insolvent, the industry is asked to contribute to a fund that can help make good people that are victims of misconduct, as ASIC said it, up to another amount above what AFIC can award, up to $150,000. And that's, this isn't a short process either. I think this is why Macquarie was so quick to act on this, because this can take years for these things to be cleaned up and for investors to be made good. And beyond that,
well, this now becomes extremely complicated. Yeah. If you're an investor that has gone through that entire scheme and then you're only able to, and there's still a shortfall, like you've received through the CSLR, there's $150,000 that's paid out. Yeah. In that scenario, there might be a class action against, for example, a Macquarie or a Netwealth. Macquarie's paid the funds out, so perhaps not, but against a Netwealth or an equity trustees, for example, there could also be class actions based on, or legal action based on, like, for example, the directors of the financial advisory firm. Ultimately, potentially something at either a licensee,
or the
asset manager, or alternatively the research house
which
level.
is just a lot of legal fees, but a lot of time.
Yeah, we're getting tenuous now. Unfortunately, it means that for these really significant amounts invested, there is a real possibility that a lot of these people are not going to get full amounts back.
And we got a question around this too. Maybe it's worth pivoting to that at the moment. So we've kind of covered who was involved in it. Where does the liability stand? We've kind of said a little bit of everywhere. It's a bit of passing the buck, as it can be in a lot of industries, and talked about what the impact is and the different source you can go to get money. But I thought this question came through, and I'm going to put this on you.
Thanks.
Which came from Super Wary, which I feel like is kind of the sentiment that it is starting to grow from I will say people with less experience with superannuation. So in a recent podcast, I learned about the CSLR, so the compensation scheme of last resort. for protection against poor financial advice. It's probably worth saying, AFCA and CSL isn't just poor financial advice.
Yeah, it's financial products. It's all manner of things. Yeah,
and I think that's key. So AFCA takes complaints on superannuation funds, on bank account, on all those sort of things. And the least of the complaints are actually about financial advice, which is quite interesting.
Doesn't feel like that way sometimes.
Given that the scheme limits the amount paid to $150,000, would it be prudent to diversify your superannuation across different providers to stay within $150,000 in the same way that I would limit my bank balance to under $250,000, the government guarantee or the deposit guarantee for banks? And this is why I think the Q&A of our podcast is so important, because it brings it back to, this is a real questions that people are thinking.
All right. Well, let's firstly talk about the $250,000 ADI guarantee, $250K. Well, one of the ways that is different and perhaps a lot easier to use is that I think it's a lot easier and less costly to have multiple bank accounts.
Yeah.
Whereas multiple super funds, you'll be paying multiple platform fees and admin fees and things like that. So if already you're a fair bit behind by trying to spread it out. Secondly, when your money is in a bank account, typically it's invested in cash, and so you still know what you're getting, and you don't have the complexity of this one's invested this way and this one's invested the other way. That would get quite complicated, ignoring cost if you were spreading, for example, $500,000 across four different investment platforms. Yes is the answer if you had a investment with Australian Super and you had an investment with Macquarie, we'll pick on you here.
Yeah.
And there were big concerns with both of those to the extent whereby you wanted to make a complaint to be remediated. In that extreme hypothetical scenario, then both of those claims would be treated independently. And so then you could conceivably have more protection. However, the question would more so be around what created the loss.
Yeah.
Now, if the loss was, I'll consider another scenario where an unscrupulous person claims to be a financial advisor, takes your money and says, I'm going to spread it across 4 superannuation funds for diversification and so on. Well, the complaint is not about the super funds. It's not at product level.
Yeah.
So it's going to be about the advice itself. And therefore, the complaint is one singular amount rather than 4 individual amounts, is as I understand it.
Yeah,
and
exactly.
So therefore, it depends on where the fault is. If we're thinking about a first guardian system or issue where there's literally fraud here, then I would imagine that having that spread across different providers might not have helped.
Wouldn't it? No.
Having said that, if we had the foresight to know that that Macquarie was going to give all the money back, for example, then would you rather have it all with Netwealth or equity trustees, or half with Macquarie and half with equity trustees? Of course, you'd rather have half and half, because at least you're getting some of it back, and then you can fight for a smaller loss with the remaining platform provider by a combination of, as you said, go to the advisory licensee. They will acknowledge payment in most cases, in the sense that, yes, we owe you the money, but we're also insolvent. So then the next step is to go to AFCA and then seek to get that resolved. AFCA would say, yep, you definitely need to pay them. And they would say, but we're insolvent. And then you would say, okay, that now we're at the compensation scheme of last resort for $150K.
There's probably little value for the people that have been impacted by this. But I think the key here is that it isn't like a government guarantee. These things don't happen very often. Like, it is a singular product and a very small group within a much bigger industry. And it doesn't help those people impacted by it. But I think, changing your entire approach, investing in multiple super funds, taking on additional fees, as opposed to having more focus or analysis of the investments that you're purchasing. So a role of an advisor and something you should demand from an advisor is transparency. Regardless of what type of product, separately managed account they're recommending, you should demand to see all the underlying investments within there. If they can't do that, that's obviously a red flag for me as well. So it doesn't help, but it's more, the schemes aren't going to save you from fraud in a lot of cases, but it does come up much less than you'd expect.
Yeah.
I think and the financial advice industry is not alone in this either. It comes up quite regularly in other industries too. So quite a dark way to close out this one. I hope this has helped kind of navigate some of that period. Have you got anything final to add?
No, unfortunately not.
It feels, if it feels like rambling, it probably was a little bit of rambling because it is so complex. It's such an interrelated web of issues, challenges, like everything everywhere. So if you're one of those people impacted, we'll put a link to ASIC in the show notes and AFCA and obviously the various methods you've got available. There is lots of information available to help you go through this process and to work out whether you're one of those people impact as well. So if you've got any questions, please reach out, send them through. We love answering Q&A and learning from our listeners as well. But once again, thanks for joining us, James.
Thanks, mate. Great chat.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.